Hello everyone. This special topic UGC net management, it's related to managerial economics concept and importance. Okay, this special topic which we are going to look for 25 MCQs. Okay, so this will be the helpful each and every topic. Suppose if you are studying for 100 MCQ, surely that related MCQs only it will be coming for UGC net. Okay, so once you've studied for the theories, after that if you're coming and watching this kind of MCQs videos, that will be helpful to you how much of theoretical knowledge which you possessed. Okay, and how you're answering on it. Once if the question which you are looking, and automatically you can answer it. So hereafter it will coming for topic oriented MCQs. Okay, from here I posted for 25 MCQs. Suppose if you required for more MCQs for the related topic, just you can comment below. I will post on it. Okay, each and every unit, this will be the first unit, and even it will be helpful for commerce student also, as well as those who are related to this respective topic. If you're preparing for PhD entrance examination for various universities, okay, as well as for respective state set examination. So whoever is preparing set, net, okay, as well as other competitive examination which is related to this kind of topic, in a sense, this will be very helpful to you. Okay, not only for the management, even for commerce student, even for economic students, okay, even some other specialization which you have taken for the management, that is also helpful to you. So let's see the first question. Managerial economics helps the business firm to predict market trends and make strategic decisions, determine fiscal policies, control inflationary pressure in the market, study the labor market dynamics. Okay, from here they have given managerial economics helps a business firm too. Okay, so from here clearly they mention for the business firm. So the answer is predict market trends and make strategic decisions. Why they have given, in a sense, managerial economics applies economic concepts to solve business problems, okay, and make strategic decisions including demand forecasting and pricing strategies. So that's the reason, in order to identify for market trends, this will be the very helpful thing for managerial economics. And for question number 2, in managerial economics, the principle of profit maximization implies. Okay, so business decisions only they are taking. So profit maximization is very important for the business, right? So the option given, maximizing total revenue, maximizing the difference between total revenue and total cost, minimizing total cost, increasing production capacity. So while you are reading itself, you could know the answer of maximizing the difference between total revenue and total cost. Why? Profit maximization occurs when a firm produces at a level where difference between total revenue. It means in order to maximize for the total revenue and reduce for the total cost. Okay, so that's the reason they have given difference between these two will be the highest. And question number 3, which of the following best explains the concept of opportunity cost? Opportunity cost, in a sense, what? If you're using one additional, okay, an additional unit, okay, it means for the best alternative things which you are choosing, right? So from here, the total cost of production, first option. Second will be cost incurred due to market failure. Third, value of next best alternative foregone, and cost of acquiring fixed asset. So the answer from here itself, you know, the best alternative. Opportunity cost, in a sense, the alternative, the word you should keep in mind, it will be in alternative. So the answer is value of next best alternative foregone. So from here the answer has been, the explanation has been provided. Opportunity cost refers the value of the next best alternative that is sacrificed when a decision is made. Okay, whatever resources will be available, you need to choose for the best alternative resources. Okay, that is called opportunity cost. And next query will be number 4, the concept of bounded rationality in decision making implies that managers make rational decision with complete information or influenced by emotions and lack of information, face limited cognitive capacity and incomplete information, make decisions slowly based on market trends. So how they will take it for decision, in a sense, with a complete, that is from here what they have given, the bounded rationality in decision making implies, so face limited cognitive capacity and incomplete information. Bounded rationality they have given. Okay, so bounded rationality introduced by Herbert Simon. Okay, this is also one more question will be coming, who introduced bounded rationality, and explains the decision making is limited by the availability of information and human cognitive capacity. Okay, that is a thing they have given. So face limited cognitive capacity and incomplete information. That means available information only, it may be full information or not full information is available. So who has given bounded rationality in a sense? Herbert Simon. And next one, which of the following not an objective of managerial economics? Not an objective. So profit maximization, cost minimization, it is also included, right? Revenue maximization also included, which is not. National income estimation. So the answer is D. So why in a sense national income estimation is a part of macroeconomics? Okay, not managerial economics. Managerial economics differ and macroeconomics is differ, right? And under managerial economics will coming under microeconomics. So managerial economics focuses on decision making at a firm level. Only for the company level only we will take for decision. And for the next question, the firm decides to produce 1000 units of a product, but due to an increase in demand, it produces an additional 100 units. Additional, so the word which has been given for additional, the cost incurred due to these extra 100 unit is known as, so additional in a sense what? That is incremental cost. It is increasing. Additionally, the word itself we have given. Okay, that is a clue. So it's called incremental cost. What is incremental cost in a sense? The additional cost incurred due to a change in production volume. That is called incremental cost. So the next query, managerial economics is based on which type of economic analysis? Macroeconomic, just before we looked, right? And microeconomic analysis, mixed economic analysis, international economic analysis. So it is related to microeconomic analysis. So managerial economics applies microeconomic concepts such as demand, supply, and market structure to business decisions. And for the next question, a company is considering whether to invest in a new project. The expected return is 5 lakh and the company cost of capital is 4 lakh. Should the company proceeds? You can look, expected return 5 lakh, the cost will be 4 lakh. So obviously cost will be less, so you can accept, right? So S, because the expected return exceeds the opportunity cost. No, because the opportunity cost is too high. Opportunity cost is too high. No, it is low only, right? While you are comparing. Yes, because profit maximization is not the objective. No, because the expected return is too low. So answer is A. Yes, because the expected return exceeds the opportunity cost. Cost in a sense, it is expenses. So return is higher, expenses will be lower, right? So while you are comparing from here itself, you can accept for the project. So that's the explanation given over here. If the expected return exceeds the opportunity cost, the investment is economically viable, economically profitable. Okay. And for the next question, if a firm set its in output at a level where marginal revenue, so marginal revenue, that is MR, equals marginal cost, it aims at MR is equal to MC. In a sense, that is profit maximization. The formula will be there. MR higher than average cost, what will be marginal cost less than average cost. These kind of formulas, if you know, in a sense, automatically you can answer this one. So the answer is profit maximization. Okay, and profit maximization occurs when MR is equal to MC. MR is equal to MC in a sense, that is called profit maximization. Sometimes they will ask you MR equal to MC, what it will represent. So you need to mention for profit maximization. In other question also they will ask when a monopoly market, profit maximization in a sense what? MR greater than equal to MC. Such kind of query also will come. So you need to answer it MR is equal to MC like that. Okay. So 2 or 3 type of questions will be asked from these kind of category. As an additional beyond the point would reduce the profit. Okay, so MR is equal to MC in a sense, profit maximization point. And for the next one, the concept of incremental revenue refers to Total revenue from production, change in total revenue from producing one more unit, average revenue from total output, revenue from fixed. Incremental in a sense what? If you're increasing, okay, so that is a thing from the word itself given over here. So the answer is B, change in total revenue from producing one more unit. Incremental in a sense, it is increasing. If you're increasing one more unit, what you will get it. Okay, so from here for the explanation, incremental revenue is the additional revenue earned from increasing production by one unit. And for the next one, decision making under condition of uncertainty implies. Decision making has full information about the future outcomes. See here, under uncertainty, if any uncertainty happen, what kind of decision making under these kind of conditions? The decision maker knows probability of future outcomes. Decision maker lack complete information about future outcomes. The decision making is aware of future outcome. When uncertainty will come, while you're taking decision, some uncertainty will come, in a sense, lack of complete information, right? So if you know full information, you cannot say uncertainty. So answer is C, decision maker lacks complete information. That is a lack of complete information about the future outcomes. Okay, so unknown, and the probability cannot be assigned accurately. So that is a thing they have given over here. Uncertainty refers to situation where the future outcome is unknown, right? So, and the probability cannot be assigned accurately. Number 12, the basic problem in managerial economic is efficient allocation of resources, price determination, profit maximization, cost minimization. The basic problem will be efficient allocation of resources. That is a main part for the business, right? If they are allocating efficiently for the available resources, they can make it for a profit. So managerial economics deals with the efficient allocation of scarce resources to maximize profit and achieve business objectives. Number 13, in managerial economics, which cost remains unchanged regardless of output level? Unchanged. So the word which is available for unchanged, in a sense, easily you can mention as fixed cost. Okay, so fixed cost is a constant, right? It is a fixing cost, we cannot change it. Does not vary with the level of output. Whatever level of output will be coming, the fixed cost, what we fixed, that may not change. So that's a thing given over here. And number 14, the concept of sunk cost refers to future cost incurred by firm, cost that can be recovered, cost that cannot be recovered, marginal cost of production. The sunk cost, in a sense, that is cost cannot be recovered. Okay, this thing you need to keep in mind. Sunk, in a sense, what? Cannot be recovered costs. Cannot be recovered, such kind of expenses. The costs that have already been incurred and cannot be recovered. Okay, that is called sunk cost. And number 15, managerial economics helps in understanding microeconomic principles only, macro and microeconomic principles, statistical trends only, production scheduling only. So managerial economics, it's related to microeconomic only, but even though they will focus for macroeconomic factors, that is inflation, GDP, such kind of things. So it will come for macro and microeconomic principles. Managerial economics combines microeconomic concepts such as demand and pricing, right? Demand and pricing with macroeconomic factors. So this factor will determine for the demand as well as for the pricing, right? So that's the thing, macro and microeconomic principles. Number 16, make or buy decision or part of demand forecasting, cost analysis, market structure analysis, financial accounting. Make or buy. So from the word itself, we can take it as cost analysis. Okay. So make or buy decision involves evaluating the cost implications of producing in-house versus outsourcing. Okay. The cost implication of producing in-house versus outsourcing, that's called make or buy decisions. The firm marginal cost is less than its average cost. Already I told you MR equal to MC, in a sense, profit maximization. So the marginal cost is less than its average cost. MC less than average cost is a given level of output, in this case what will happen? So the answer is average cost is decreasing, average cost is increasing, and second, average cost is constant, average cost is decreasing, and marginal cost is higher than fixed cost. So the answer is marginal cost is decreasing. Okay, so marginal cost is less than average cost, in a sense automatically average cost decreasing. As the same way it will ask marginal cost is higher than average cost, in a sense it is average cost is increasing. Okay, so such kind of things, once if it is coming one query, you can make it for 3 different questions in that. See here, average cost, the cost decrease because the additional cost of production, one more unit is lower than the current average cost. Why? In a sense, this is the reason. Number 18, a firm break-even point occurs. Break-even point, in a sense, what? The total revenue as well as the cost. Revenue which you are making and whatever expenses, both are equal. So the cost exceeds the revenue? No. The revenue exceeds the total cost? No. The total revenue equals total cost? Yes. Fixed cost equals variable cost? No. So the answer is C. So from here, the break-even point is the level of output at which total revenue equals to total output, resulting zero profit or loss. That's called break-even point. Managerial economics is based on which of the following principle? Economic policies, government, macroeconomic principle only, microeconomic analysis with business strategy, market equilibrium model only. So from here, microeconomic analysis with business strategies. Okay, so the answer is C. So same kind of query, earlier they asked some other way, right? And right now it's asking in another way. See the questions how they are asking. Okay, so that's the reason the PYQ is very, very important. Whatever theory you study, theory you can study very less, but if you are practicing for the MCQ for the related topic, in a sense, you will get an idea how you can answer it. Okay, so for the explanation for this one, managerial economics combines microeconomic principle with the strategic business decisions to maximize firm's performance. And for the next question, the concept of opportunity cost is useful. Opportunity cost, in a sense, I told you the word you need to keep in mind, it's alternative. So analyzing sunk cost, determining fixed cost, evaluating alternative use of resources, measuring the total cost. So the answer is C, evaluating alternative use of resources. So the explanation, opportunity cost measures the value of next best alternative forgone when choice is made. And number 21, if a firm increases output and the average cost decreases. Okay, firm increases output, the average cost decreases. This situation reflects law of diminishing return, economic of scale, constant return to scale, diseconomic of scale. So you need to know economic of scale, in a sense what, as well as diminishing return. Okay, that diminishing return, that also you need to know. Then automatically you can answer for this kind of questions. Okay, so economic scale, in a sense, when the firm output level will increase, average cost decrease. Okay, so this one, call it as economic of scale. So the answer is economic of scale, and when average cost decreases with an increase in output. Okay, it reflects economic of scale which arises from increased operational efficiency. Okay, so economic, what is economic profit, what is normal profit? Okay, so these kind of things you need to learn it. Okay, so increasing return to scale, these kind of things you need to learn. Then automatically 3 type of questions you can answer it with this. Number 22, in a perfect competitive market, a firm will continue production in the short run. See here, from the word it has given short run. Sometimes same question will come and they will ask for the long run. Okay, the firm will continue production in the short run. Price covers total cost, price covers average variable cost, price covers average fixed cost, price exceeds marginal cost. So what will come? Price covers average variable cost. So in a short run, the firm will continue production if it can cover average variable cost, even if it is not covering total cost. So price is required as well as variable cost is required in terms of short term for perfectly competitive market, okay, to minimize the losses. And for the next question, which of the following factor does not influence demand of the product? Consumer income, see here, does not, okay. Consumer income, price of substitutes, production cost, consumer taste and preference. This is also required, right? And this is also required and this is also required. So production cost not required, okay, for the demand of the product. So answer is C. Demand is influenced by consumer behavior and market condition, not production cost, which affect supply. Okay, production cost will be affect for the supply, not for the demand. So you need to look what is that it is related to demand or supply, and they are asking for influence or not influence. You need to read a question twice, then only you can answer it in a proper way. And for the next one, incremental cost refers to incremental in a sense what? That is additional. How we can said earlier opportunity cost in a sense that is alternative, as the same way incremental in a sense additional. So average cost of production, increasing the total cost due to producing an additional unit, the total cost of production, and fixed cost only. So I already told you from here additional. So the answer is additional. Increasing total cost due to producing an additional unit. So incremental cost reflects the increase in total cost from producing one more unit of output. And the last question, which of the following is an example of implicit cost? Wages paid to workers, rent paid to factory, interest on owner's capital, cost of raw material. So implicit cost, which is interest on owner's capital. So what it means for implicit cost? That is opportunity cost of using own resources. So implicit cost in a sense, which is a cost which we are using for own resources such as interest on owner's capital. That you need to keep in mind. Implicit cost in a sense that the word called owner, how we look for each and everything for the clue, right? As the same way, implicit means that is owners related. So interest on owner's capital will be the answer. I think these all 25 questions which we looked, once you studied for theory, then you can come and watch again for this one. You can able to answer it or not. Just you can pause a video, then you can answer it, then you can move on for the next question like that. Okay, by that way you can equip yourself and easily you can clear for UGC net also. This respective information which is helpful to you, in a sense you can subscribe this channel and keep on watch, as well as you can give a like, and this will helpful for other student, they can watch for more people. Okay, as well as you can comment below you need more MCQs related to this topic or else some other topic, in a sense comment below, I will post regarding that topic. Okay, thank you everyone, thank you for watching this, bye.